Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, February 17th, 2021. And here are our top stories. Does a corporation's ESG rankings influence its stock valuation? And encouraging ESG investing by retail investors. Well, joining me now to discuss this and more is Bob Colley. He is a principal and founder of Colley ESG. Bob, great to see you. Thanks for joining us on the program this morning.
It's a pleasure, as always.
So our first story this morning is, and I'm just going to boil it down into a short tidbit here, which is, do the environmental, social, and governance factors of a company really matter to its stock valuation? Go, sir.
Short answer to that is yes. And obviously the long answer, as with anything in the market, the long answer gets involved in the question of, well, how much of this is priced in? As you know, everybody's talking about ESG now, the environmental impacts, social impacts, and everything else that's associated with that. And so there's a lot more attention being paid by investors now. And what that does is it does two things. As you know, once markets start to pay more attention to something, it tends to mean that the market gets more accurate in pricing those things. Markets are very, very good at finding a fair price for a factor, whether it's a momentum factor or a technical factor or an ESG factor. All of those things, when markets start paying attention to them, there's buyers, there's sellers, you find that price at which they all agree. That's one way to work out what's a good, fair price on this. So the very fact that everyone's paying so much attention now to ESG factors means that creates a different pricing dynamic today to maybe the pricing dynamic that there would have been in the past. And you'll see studies that will say that maybe this factor outperformed in the past, or maybe a factor may even have underperformed in some studies. But those studies of the past don't necessarily tell you what's going to happen in the future, because once the market becomes aware of it, well, the market tends to be quite accurate in pricing that in. So that because there's been so much attention paid to these factors now, it's just one of those things that investors take into account. It's one of those things that drives prices along with everything else in the market.
Now, Bob, we're going to talk about maybe some of the different types of investors, institutional and retail, in our next segment. But because, and I'm going to give a little bit of it away, but because there are so many institutional investors in this space and they're driving a lot of this flow and a lot of allocation, what does that say? What potentially does that say about their appreciation for ESG? And in a way, does this actually force a company, and I'm not coerciveness, but and not blunt force, like hey, you better do this or else, extorting people. But what does it say about stock valuation processes in general? And then when I come back after we answer this one, I got another question about those factors themselves. So why don't you take this one first?
So the rationale. So why do people care about ESG? And there's two answers to that, and one of them is purely financial. One of them would be it doesn't matter that whether you're saving the earth or whether you're creating social equality or any of those things. You can look at this through a purely financial lens if you choose to do that, and there are important factors on that account. So that's one side of the coin. But then the other side of the coin is that these are things that typically we care about. We have a desired outcome. We as an economy, we need to burn less carbon. I mean, that's just the reality. We have to find a way to somehow transition the way that we do everything so that there's not as much carbon being burned and slow down climate change. So as people take these factors into account, there's definitely these kind of twin goals going on at the same time. On the one hand, people are trying to maximize their returns, and they're saying, well, we have to look at, let's stick with the carbon. We have to look at companies' ability to handle the future, which is a less carbon world. How well positioned are companies for that transition, which is going to come? At the same time, investors generally want to encourage companies to make that transition as well. So there is a social side to it, and there's a financial side to it, and they're working in harmony in a way to encourage attention being paid to this. And then investors are free to choose for themselves the extent to which they emphasize one or both of those sides of the motivation.
Now, Bob, we have talked in your last appearance, we talked about benchmarking and the actual factors and trying to come up with a standard process. And I would think that would be, and I think you said this is important to things like valuation and comparisons. Has there been any further development there with regard to that? I mean, are there any, I know there are organizations working together, there are fund of funds and funds working together to do this, but what's the latest in those developments? Because I would think that would be important to that whole stock valuation decision making.
It is, and the benchmarking, I have to say that this is not going to be a great answer. I warn you now.
Of course.
Because we want answers to be simple. We want to say, oh, the answer is X, and this is what we need to do. The reality is, when we're covering such a broad range of issues here, it's not just climate change. That's a huge one, but there are a lot of social factors. There are other environmental factors beside climate change which really matter. You've got the ocean acidification, you've got the soil erosion globally, a lot of things to be concerned about when you look closely. And so for all of these things, there are different measures that you need to track to do a really good job of saying, where do we want to be? And so it quickly, if you're a serious ESG investor, the amount of data that you want in order to understand what's going on just magnifies and magnifies and magnifies. And this creates problems because that data doesn't always exist. And when you try to get it from companies, you might say, well, we need data on this, and this. And then the companies say, well, that's too much to provide. And the companies have got a point. Their reports are already this thick. And do we want them to be this thick? So finding a way through those data needs in order to say, to allow investors to do the analysis they want to do without just overwhelming companies with all the reporting requests, is definitely, there's a lot of work to be done between the reporting bodies, the corporations and the regulators to find that right balance and a way forward on that one. So, I wish it was simple, but there's a lot happening here, and a lot of kind of fine detail on making it work and getting the data that investors need to do a better job here.
Yeah, well, like at most things in life, they're not black and white, they're not simple. Well, Bob, I want to go to a very quick break. When we come back, we'll talk to Bob about the breakdown between institutional investors and retail investors. What's he think? Well, you're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Hi, folks. Joe Namath here, and if you're on Medicare, this is important. You're now entitled to eliminate copays and get dental care, dentures, eyeglasses, prescription coverage, in-home aids, unlimited transportation, and home-delivered meals, all at no additional cost. Plus, your zip code may have coverage with the Give Back benefit that adds money back to your Social Security check every month. Look, with the uncertainty of the virus and vaccines, you need to get everything you're entitled to. Here's the bottom line. Call to get significant benefits at no additional cost and see if your zip code has coverage with the Give Back benefit. Millions of people have trusted the Medicare Coverage Helpline. You can too. Call now. It's free.
Call 1-800-924-3920. That's 1-800-924-3920.
Welcome back. We're talking to Bob Colley of Colley ESG. Bob, thanks for staying with us this morning.
It is a pleasure, Jeffrey. I love talking to you.
Yeah, well, it's great to hear the latest, and you've got your ear to the ground in terms of what's going on with ESG. So it's great for you to come on and talk to our audience. So Bob, as we talked about in the first segment and kind of alluded to going into our second segment, much of the flow, and I want you to correct me if I'm wrong, but much of the flow seems to be from institutional investors. And institutional investors could be endowments, foundations, pensions, retirement plans, all sorts of pools of capital, even companies or not-for-profit organizations. But some of it, there's very little or not as much in the retail segment. So first, I want to get your thoughts about this, and we'll talk about how do we improve that. Go ahead, sir.
That's certainly true today, that the big flows have been driven recently by the institutions, and that's normal with any new trend in investment, that the institutions will tend to be faster to move to it, which is not to say that there's no interest on the retail side. So there have been a very well-established ESG market, not always gone by that name, it's had a few names over the years, but the people that care about one factor or another have been investing that way for a long time. But it's been a niche market on the retail side. It's kind of been a segment a little bit away from the mainstream, and what we're seeing in institutional is it's not niche anymore. This is now front and center and being considered right there as mainstream investing. And that transition hasn't quite happened yet on the retail side, certainly among US investors. Here in Europe, there's a lot of interest among retail investors, and to some extent, if you go down to Australia and other places, things are really ramping up as well. So the US retail market, as I say, there's not nothing, but it hasn't gone mainstream there just yet.
And as you point out, I mean, there is great interest. I mean, you can break down the different cohorts, millennials, people who are socially interested. Many different people in the retail segment are interested. How do you suppose we get more people, or people get more involved on the retail side? Is it more information? Is it part of that standardization that of data? Is part of this? Because I know there are probably a lot of fund managers and people in the space, not just watching you and watching us, probably looking for some ideas. So how do we migrate so that it's not just an institutional thing, but it's more, we get more of that 25% up to say 50 or 75%?
It's happening. So the fund managers that you know about, whether it's obvious or not, they're all talking about this internally because they know that this is a big growth area. They're looking for where the new money might come from, and they see the trends, and they see the trends globally, and the US is no exception. And so there is a lot of interest among money managers, and what drives that? I think all of the things that you've mentioned there. But let me just add one of them that we're seeing some really interesting developments within Europe, which is driven by the regulation here. But as the asset managers respond to that here, those lessons are going to definitely cross the Atlantic because it's the same firms in a lot of cases with the operations in both places. And what is being driven here is it's the conversations with clients here. Before too long, there will actually be a regulatory requirement for an asset manager or an advisor dealing with a client to work or to discuss with them what are their sustainability preferences. And once, if I'm an advisor and I'm required not only to know what your risk objectives are, but also what your sustainability preferences are, well, in a lot of cases, they might be reasonably standard ones. In some cases, they might be very specific ones. But once I have that information, my whole relationship with you is different. My obligation to find good products that satisfy your needs, well, that's different as well. Because now I'm no longer just thinking, well, how do I meet your risk objectives? I'm also thinking, well, is it possible to match the sustainability preferences within the portfolio as well? Now, in most cases, the investor's going to say, and so I care about climate change or whatever it is, as long as there isn't a financial cost. In some cases, the client will say, and you know what, even if there's a bit of financial cost, I care about it enough that I'm willing to take that. And in some cases, they'll say, no, I don't want you to think about this at all, even as a tiebreaker if there's no financial cost, because I want it to be money only. And so different clients will give different answers, but that's going to mean that the asset managers get much, much better at having more products available, more different ways to meet different client needs. And once the asset managers are able to offer those products, I think we're going to see a lot of interest, and a lot of, the market will, there'll be big variety, there'll be better choice for you to find something that maybe matches exactly what suits what you want, because what you think of as being a responsible and sustainable investment, that might not be the same as what I think of it. So as managers talk to their clients, as advisors talk to their clients, we're going to see a lot more choice develop, I think.
Bob, a lot of investors choose index funds, whether it's mutual funds, whether it's separate accounts, or exchange traded funds. Could that be, and that has really led to people really having broader access to the market. And I've seen reports where S&P and other MSCI, I don't want to leave people out, who are creating indices for ESG. Is that a way for, one, keep costs down, but also buy a broad index and say it's the index about lower carbon footprint, or just in general, maybe it's the S&P 500 that is more ESG focused. Is that a way to really create more proliferation of the market?
Yes, it is. I mean, it's not the only way, but for sure, all of the index providers, again, this is what they're best at, is getting a list of names, and as long as you can give them the definition of here's what we're trying to achieve, they can do the math, they can find the algorithm to tilt the index and produce something that's maybe a more responsible version of whether it's the 500 or whether it's the all world, whichever index you're interested in. Variations of those already exist, and I think that the selection of new versions is only going to keep getting bigger. As you know, the number of indices that are available now is huge, different variants, and so that's definitely one of the ways that investors can access this stuff.
Well, Bob, this is certainly a growing area. I think we're going to have plenty to talk about over the course of the next few months. Really appreciate you coming on the program, and we look forward to having you back again to talk more very soon. Thank you, sir.
Thanks as always.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place, check out today's edition of our newsletter, The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a tax doctor now for a tax emergency analysis.
Call 800-224-6439.